Good morning. Welcome to IG's early morning call. It's Tuesday, the 16th of May. Let's take a look at the headlines. As economic data out overnight seems to suggest that there's a big question mark over this well-anticipated recovery in China. It just doesn't seem to be happening. We've seen some poor numbers coming through today for both industrial production, retail sales, and also foreign direct investment. Meanwhile, UK earnings as a whole pack of companies reporting numbers this morning. Lots of trading opportunities today. We'll be covering Vodafone, Imperial Brands, Greggs, On the Beach, and we got numbers as well coming through from Britvic amongst others on the list in today's trade. And US retailers getting in on the numbers as well today. We got the retailers kicking off with the home improvement company, Home Depot. It reports before the bell today, and it's one of those stocks that trades all sessions on the IG platform. Take a look at volatility. We've got a slight uptick today. There's none of the volatility expected that some were saying could well accompany this business about whether or not the US is going to step in to help out the budget in the States. It always happens. Why should we be concerned this time around? It's just another one of those games, I think, that politicians play in the States where they want more money. They say they're not going to give it, and then all of a sudden at the last minute it comes through. So I think that there's no real concerns in the market about that. More concerns, I suspect, about what's happening in China, although as you can see, we're not too far away from recent lows for volatility, which means that these markets continue to be fairly well bid. That being said, we are expecting a small drop at the start today on the European markets. This is the London FTSE 100, resting at the 100 period moving average on the blue line at 77.68. Not too far away from recent highs, of course. This record high that we saw back in February this year at 80.44. It's just a question of what, 300 or 400 points away from where we are there. So the market's really not too far away from those highs. Let's take a look at what's happening on the German and French market. Same sort of price action after yesterday's gains across the board. A little bit of an easing back into the trade. We're currently trading at 100 points or so away from the 16,000 level on the German DAX. Same with the French CAC 40. After yesterday's gains, a pullback in the market, resting at 7,400 on the French CAC 40 at the moment, ahead of the opening of the session today. So we are expecting a slightly lower start. Let's take a look at what's been happening overnight in the Asia-Pacific markets. Now, I want to show the Nikkei 225, which, as you can see here, is up 0.75%. The Topics Index. Now, this is the broader market in the Japanese indices. And the Topics is knocking on the door of a 33-year high. Hang Seng Stock Index up on the session in today's trade, despite the fact we've seen some poor economic data coming through in the Chinese economy today. S&P ASX 200 down 1/3%. Let's show you the Nikkei 225 chart, which is currently trading 170 points away from near 1.5-year high. These are levels not seen since November 2021, and you can see once we get over the 30,000 level, which I think is looking more and more possible, the markets in the 24-hour session down at the moment at 29,833 on from the 2 days of very strong gains that we've seen on the Nikkei in the last couple of days. But as I say, we are only just a handful of points away from the levels we've not seen since the middle of November 2021. And then when we go over the 30,000 level, you're then back to levels not seen since September 2021. So any upside, with further upside, a little bit of a headwind ahead of us. If you're long on this, your stop would go underneath the 29,500 level with a view to passing at 30,000 if you think the market's going to continue to rise. Wall Street closed last night, gains across the board, as at the end of the session yesterday. It wasn't a particularly staggering day yesterday on the Dow, up just 1/7 of 1%. Slightly better than that on the S&P 500. NASDAQ continues to be one of the upside outperformers. And in fact, if you look at the NASDAQ chart, that 2/3 of 1% gain yesterday wasn't quite as high as we were at the back end of last week. But nonetheless, the market's trying, I think, to get beyond that point. If we do see a trade higher than the intraday that we saw back on Friday last week at 13,434, we're just a question of 50 points away from that, you're then knocking on the door and taking us to levels not seen since August 2022. So money continues to go into those tech stocks. Now, at its last meeting, the Reserve Bank of Australia, the RBA, considered a pause in its rate rising cycle, but in the end it decided to go for a 25 basis point interest rate rise to 0.5%. This is as a result of the minutes that we saw out overnight. That from the last meeting, which shows an unexpected decision by the central bank, justified by inflation risks from weak productivity growth, persistently high services inflation, according to the statement, and faster than forecast rental increases. The minutes show that in weighing up the two options, members recognised that the arguments were finely balanced, but judged it appropriate to increase interest rates at that meeting. Members also agreed that further increases in interest rates may still be required, but that this would depend on how the economy and inflation evolve. I want to show you what's been happening with the Australian dollar today, which is on the way down against the US dollar at 66.68. At the moment, markets pricing in an 85% chance of a pause in June, while seeing a higher risk of a hike in August or September. Now, the line to look for if you see further weakness in the Aussie is down here at 65.64. We're currently trading at 66.68. If you're short on this, your stop goes above the 200-day moving average, around about the 67.40 level, with a view to going to that price target at 65.64. Now, we're right in the middle of this band between the 65.64 and the highs that we've seen in the last few days at 68.18. So there's an equal chance, I guess, that we could well see the Aussie recover against the US dollar. Much of what's going on, of course, dependent on the US currency. Now, as a consequence of the last RBA rate hike, Westpac consumer confidence taking a little bit of a hit in the month of May. The index falling to 79 from 85.8 in April. In the statement accompanying the data, Westpac chief economist Bill Evans said the two key developments over the last couple of months have been the surprise decision by the Reserve Bank of Australia to lift the cash rate in May, and also the federal budget. Now, is the Chinese economic recovery losing its momentum? The latest set of macroeconomic data suggests that this could very well be the case, adding pressure to policymakers at the central bank in China. Industrial production rose 5.6% in April year-on-year, accelerating from 3.9% rise seen in March. Now, under normal circumstances, this might be seen as good, but it missed expectations of a whopping 10.9% average expectation by economists. Same sort of thing happening in retail sales, also accelerating in April. Index rising by 18.4% in April year-on-year after a 10% rise in March, also below expectations of a 21% rise. Expectations seem high, but they're skewed by heavy declines in April 2022 when major cities, including Shanghai, were placed under stringent antivirus lockdowns. Fixed asset investment increasing by 4.7% in the first 4 months of the year compared to the same period last year, undershooting the consensus of 5.5%. Now, investment in the property sector, a key pillar of the economy, tumbling 16.2% year-on-year last month after a 7.2% drop in March. Now, what does this mean for interest rates? Well, China kept the interest rate picture unchanged last time it met for an 8th straight month. That was back on yesterday, but markets are now betting on more monetary easing in the coming months. Clearly, this data is showing an increase, but the increase is not as spectacular as had been hoped back in January when we heard news from the central authorities in China that it was easing back on those COVID-19 restrictions. So the developments haven't been as good as many had been hoping for in this first part of the year. Now, let's move on, take a look at some other economic data that's come through. Some relatively strong numbers coming out from the UK economy. Let's take a look at what's happening in terms of some of the news that we've seen today. The unemployment rate unexpectedly rose to 3.9% in March and 3.8% in February. This continues to be one of the best amongst the European economists. The April claimant count change of 46,700. March had been 26,000. I think for me, one of the other takeaway items worth watching for in this number out today was the rise in average earnings, excluding bonuses, 6.7%. Now, we have been looking for a figure around about that. What that means is basically when you get 10% inflation, we've still got rises in wages coming through less than inflation, which is really what the central bank wants to see. And of course, this gives rise to all these claims that everybody wants to strike to get more money. But at 6.7%, you can see that money is still flowing into people's pockets, but just not the same sort of rate as we're seeing price rises. Now, let's have a look at what's happening with sterling against the US dollar. We have seen a little bit of a pullback in today's trade at 124.66, not too far away from the recent highs that we saw back on Wednesday, the 10th of May at 126.80. So we've still got around about 4 cents away from that. But nonetheless, the direction of travel remains on the way up. And if you're long on this, despite the fact we got a loss today, if you're long on this chart at 124.66, your stop would go below the 124 level, somewhere a little bit below where we are, if you consider that we've got more gains to go in the longer term picture for sterling against that US dollar. Let's take a look as well at what else is happening in the markets, because we've got some economic data a little bit later on today for the eurozone GDP. Let's take a look at that. It's a second estimate, so it may not be too far away from what we saw the previous rate of 0.1%. That's certainly what economists are expecting. It's quite anemic growth, quarter on quarter, year on year, 1.3%. You remember here in the UK that we've seen some slightly more robust figures coming through for the first quarter. That being said, remember in March, the monthly data out from the ONS here in the UK showed a contraction, which was a bit of a surprise. So it'll be interesting to see whether or not we're seeing some creeping weakness coming through from these numbers. Also at 10 o'clock this morning, UK time, we get the German ZEW economic sentiment data. The index is expected to fall for a third straight month to a negative 5.5, which would set a new low for the year. Before we take a look at euro dollar, just a quick update on US stats later on today. The market awaiting retail sales for the month of April in the US, economists seeing a 0.7% rise month on month. Industrial production expected to stay flat in April. And the NAHB housing market index anticipated to remain at a reading of 45 in the month of May. All this data on both sides of the Atlantic could well give us a little bit of a steer on the euro dollar trade. Euro dollar not too far away from recent lows, a little bit of an uptick in yesterday's session. 108.68 is where we are for this chart. Remember, I drew this Fibonacci on here a week or two ago now. And I was looking at this line of support at 107.39. Up until a couple of days ago, I was still hopeful that we're going to get a bounce off that. But in fact, it looks like the bounce has come now on where we are. However, if you are still short on this with a view to going down to the 107.39, which will give you a better opportunity, I think, to go long on this, assuming you're expecting the US dollar to continue to fall for the remainder of the year, which certainly seems like most people's expectations, bearing in mind the Fed almost certainly seems to be done, certainly for the time being in terms of interest rate rises. So if you are waiting for this pullback here and you still have a short position open, if you want to continue to bring your stop loss in to try and protect your profits that you've got. If at any time you think that there's going to be a rebound in the euro, then obviously your stop would go underneath recent price action with a view to taking it higher. But this is certainly my price target at 107.39 when we were looking at this last week on the data and the charts that we had for the euro dollar. Now, let's take a look at what's happening in terms of some of the numbers out. I want to begin, first of all, with one of the biggest stocks here in the UK, outside of oil companies, that is Vodafone. It's on its full year numbers. Boss Margarita Della Valle wants to cut 11,000 jobs over the next 3 years as the telecom group must change, according to the data out this morning. EBITDA falling. This is one of these things where you keep on hearing more and more differences, but broadly speaking, it's earnings before interest, tax, depreciation, blah, blah, down by 1.3% to 14.7 billion. Total dividend, 9 euro cents. Vodafone forecasting little or no growth in earnings for the new financial year. And clearly the new chief executive wants to try and find ways of trying to make up some of the difference by cutting costs. Look at the share price chart. I think there's good reason for taking this down over the last few days. I don't like the look of what we've been hearing from Vodafone this morning. The stock will open at 89.8 pence. If you're short on this, your stock goes above this area up here to around about the 94 pence level, with a view to taking it down from where we are. Imperial Brands, meanwhile, reporting a rise in half-yearly profit, operating profit rising just over £1.5 billion from 1.2 billion this time last year. Dividend up 1.5% to 43.18 pence. The tobacco firm saying it's on track to complete its £1 billion share buyback programme. Imperial Brands, like a lot of these tobacco companies, are trying desperately to find other forms of income. And that income is coming through from the vaping, which Imperial Brands is very large in. Yesterday, the stock closed down at 18.71. If you are long on this going to the start of today's trade, if you like what you see, your stop goes underneath this line of support down here at around about the 18.20 level. 18.71 is where this stock will open at the start of today's trade. Another company to watch out for, Greggs. Sales continuing to grow at the high street bakery chain. Like-for-like sales up 17.1% in the first 19 weeks of the year. Total sales reaching 609 million pounds after 495 million this time last year around. Full year guidance remaining unchanged at Greggs. Greggs continues to work on the company, the outlets that it has. It's one of these companies that's able to change quite quickly to make maximum opportunity for footfall, and they've got all that very well taped, and they continue to open and close stores. Got this rising line of support, these higher lows and higher highs that we've seen. The last couple of weeks, we've seen the highest print in shares seen since the 11th of January 2022. So we're up at something like around about 16-month highs, or not too far away from the 28.42. If you're long on this, the stop goes below the 2800 level, with a view to taking that higher as well. Broadly speaking, things on the way up at Greggs as we see a continuation of people going back into the office. Now, let's move on and take a look at another chart. This is for Boohoo Group. I want to show you this as I talk about the earnings. You know the share price movement that we've seen for Boohoo as it crashes from the COVID highs that we saw, over £4 a share. It'll open at 30 pence today. Significant market share gains over the last 3 years, the company said this morning, with sales at 43% and the UK up 61%, but it coming at a cost as the company invests for the future. Pre-tax profit is down a whopping 101%, down at 82.5 million, despite the fact we saw revenue up 43%. The strong cash generation has come in from that reinvesting into the business. So where does it go from here? It's difficult to know how this will be interpreted this morning. The company says it expects to get back to EBITDA margin growth of in excess of 10%. Expectations at the moment for the current year are between 6 and 8%. Through scale and unlocking cost deflation and overhead efficiencies, the company says it's on track to see an expansion of the margins as it goes into the back end of the year. It'll open at 38.8 pence. I think this stock is just as likely to drop as it is to rise at the start of the day, based on what we've got in terms of the numbers this morning. And I'd be interested to see just which direction the stock opens up on in today's trade at the top of the hour. Again, staying on the charts, one of the other companies worth looking at this morning is On the Beach. Now, this is a company which is part of that big travel change that we're undertaking in the last 18 months or so as people return to holidays. This looks to me like a positive stock story today. Group book total transaction value for the period up 28% year on year to 495 million, resulting in group revenue up 38%. This was driven by increases in passenger bookings during the period, as well as an increase in the average value of holidays sold. I've drawn this line here at 122.9 because I think if you do want to go long on this, the stock closed out yesterday's trade at 127. You want to go long, you want to hide your or put your stop loss underneath, very close underneath this line of support at 121. I can't see anything in this as necessarily particularly concerning. The revenue supported by investment in the brand and the proposition. Remember that thing you're hearing on the radio recently, the Most Wonderful Time of the Year campaign, which is really big, and On the Beach spent a lot of money on that campaign, but it has seen people coming back and booking holidays this summer. But of course, we've got exactly the same story coming through from TUI and all the other holiday companies that book holidays. It is a big return to the air and a big return to holidays this summer for people wanting to get away after being 2 or 3 years stuck at home. Staying on the charts, again, I want to take a look at another company I think worth looking at. This is Britvic. In the last couple of days, we've seen this stock trading intraday levels not seen since the 4th of Feb 2022. The stock will open at 932 pence. Revenue up 7.9% to 749 million. EBITDA, adjusted EBITDA, increasing 16.7% to 85.3 million. Operating profit up 21%. EBITDA margins as well increasing 80 basis points to 10.7%. Profit after tax increasing 21%. I think these numbers look good, broadly speaking, for Britvic. The only concern I have is how much is already baked in the pie, bearing in mind where we are in terms of share price at 932. If you're short on this, already having seen the uplift in share price, your stock goes over the 940 pence level if you're short on Britvic. But I think this is, broadly speaking, a positive result coming through for the company for the full year figures out this morning. Now, over in the US, Home Depot will kick off the US retailing earnings this week. The market expects a tough start to the year for home improvement companies. High inflation has forced consumers to restrict spending and favour essentials such as food and energy. As a result, more homeowners have chosen to delay renovation projects. You may remember earlier on this year, Home Depot warning it expected earnings to fall by mid-digit percentage this year and sales to be broadly flat. Well, let's take a look at what's expected. This stock is an all-session stock, which I'll show you in just a minute. For the first 3 months of the year, analysts expecting earnings to fall around about 7% to $3.87 per share. Revenues coming in, expected to come in at 38.6 billion to be compared with 38.9 billion in the same quarter this time last year. As I said, it's an all-session stock, which means it gets underway at 9 o'clock this morning, UK time. And this stock reports 2.5 hours, 3 hours a bit later on than that. We're expecting the stock to open at $288.77. If you are long on this going into the numbers, your stock goes underneath this line of support we've drawn on here, which is the low point we saw back on the 28th of March this year. So you'll stop at around about just under the $280 level. 288.77 is where we are going into the session today. If you want to go short on this, your stock goes up here over the 200-day moving average at around about the $302 level. So that's one of the stocks to watch at the start of today's trade in the US. Just one other area of the market to watch out for, just a couple of headlines on the commodities sector. This is gold, just showing a chart of gold, that we are continuing to rest above the 2000 level, not too far above, but we simply seem to be now using this as a level of support. If you get a break of that, you're then on the way down to these moving averages down here. And the price of oil, broadly speaking, not too far away from holding on to the gains that we saw in yesterday's session of gold. This happens to be Brent, trading at 75.13, a little bit weaker on from where we were at the close yesterday, broadly holding on to much of the gains that we've seen. That's it. We've got about 8 minutes to go before the start of today's European session. Back at 10:30, we're charting the markets. Whole long list of stocks to watch at the start of the day's trade. Most of them here in the London markets. I won't say they're going to be leading massive gains at the start of the day's trade, because that would not be correct. I think on balance, these earnings coming through from these companies this morning have not really impressed the markets. And those that have impressed the markets have already seen share price gains like Britvic. So watching those companies at the start of today's trade.